Hey, welcome back to Happy Investors. We're going to talk about the Vanguard All World, excluding the US ETF. Now, Warren Buffett is known for one of his quotes, which is, "Never bet against America." Well, Warren Buffett, one of the best investors in the world, has recently closed a lot of positions, sold because he's not so sure about all his positions in America. And I've also published several videos about the relatively high valuations in America. I have also positioned my investment portfolio more towards Europe. And I think there are definitely some opportunities in other countries, but America still remains a bit tricky to predict what exactly is going to happen. Also, because of those developments with Trump, now there is an ETF and it's called the Vanguard All World, excluding the US ETF. Everyone knows about global ETFs like the Vanguard All World ETF, my shares, All World ETF. And such a fund is focused on the whole world. So to one, in practice, you'll see that this ETF contains a lot of stocks, more than 3,000. However, about 70% of that is locked in America. Well, these companies have significant international sales, but that's just a bit of detail. But 70% comes from America. And then 30% of that is spread across other countries, sometimes not even in emerging markets like Asia, for example. But this ETF, Vanguard All World ETF, excluding the US with the ticker VEU, so it specifically targets all continents except America. So is that a good move? Yes or no? In this in-depth analysis, we're going to talk about that. My name is Jorik Vermeulen. Welcome to Happy Investors. We create inspiration through our channel to help you with simple investing. The question is perhaps why? Why would you want to follow this? Now, I've been investing for over 10 years myself, and along the way, I've made a lot of mistakes. Fortunately, I've learned from it and gotten better. But simple investing can actually be done in very straightforward ways. And one example of that is investing in ETFs by sharing our knowledge, and especially from my own experience. But we also have a team from Happy Investors through YouTube. We definitely won't be worse off. We receive a portion of advertising costs from Google, just to give an example, although that is very small. But the long-term effect could be reputation from Happy Investors because we genuinely help you towards financial freedom. That's our goal. And the second part is actually more of a matter of principle that I believe in myself. I really believe in it. Helping people achieve financial freedom. Financial freedom is not the solution to life because it's not about the money at all. Money is actually bullshit, and I know what I'm talking about. Because, first of all, from a young age, I had a strong ambition to create a lot of money. I don't really know why, but I did have that ambition. Financially independent, that's what I wanted to be. And secondly, I know from experience what it's like to become financially free at 30, and by now I am working towards financial independence. That doesn't mean I'm a multimillionaire. No, I'm not that either. I'm actually a good example of someone who has made a lot of mistakes, but simply by studying hard and working hard, despite all the mistakes, you can still achieve financial freedom and still reach financial independence, all before I turn 40. So I'm actually an exceptionally good example, also to inspire you. And the easiest way is to help you achieve financial freedom because it removes certain frustrations in life. What it ultimately comes down to, what I believe in is living in the here and now. Just have fun, do what you're good at. Creating value, exactly because you do things that you're good at. Only a lot of those things are made more complex because money always plays such a role. While money is not a limiting factor, it's something you have to make work for yourself. Well, long explanation, but I believe in it by helping people. On one hand, by helping you achieve financial freedom, I hope that you achieve that status in time, that you let yourself be less driven by, for example, a bit of money. That way you create more energy, freedom, and control to do things that add value again back to the world, because it's not about the money. But not everyone is able to earn a lot of money, even if it's sometimes a bit of intelligence that's also lacking, but that's okay. What you can do, what everyone can do, is simple investing. Simple investing in ETFs. After this analysis of the Vanguard, All World X US ETF with the ticker VEU. Now you know exactly what this ETF is about. And we're going to take a step further. I'll also show you a simple technique to increase your returns by actually investing in a very simple and passive way, because passive investing, that's what is central to this fund. One of the advantages is, for example, that it has a very low expense ratio of just 0.04%. Expense ratio means the annual cost that management charges for managing the fund, and in comparison, actually cheap funds are all below 0.2%, and this is 0.04%. With that, VEU is not only a very popular fund, but it is also one of the cheapest ETFs you can find. From what I remember, it's the cheapest 0.03% toss. So that's just a difference of 0.01%. Depending on the broker you have, you can find the ticker VU or a variant of it. It really depends on which broker you have and what is available with them. But actually, the fund is so popular that there's always a solution. For example, I invest through DeGiro, which, by the way, is not advice, but I invest through that, and also interactively brokers. But with DeGiro, for example, we don't find the original ticker. Well, in my case, I'm Dutch and I prefer not to have any currency risk. So I actually want to buy the Euro variant. And this exchange just happens to be in Amsterdam, although we might also be able to use the one in Milan. But here we see, if we search for the ticker VEU or simply type the name Vanguard All World ETF in the search function, then we see a suitable candidate. And so you can find the ticker or a variant of it, depending on where you live. Let's take a look at some characteristics of why this fund is actually so popular. But not only that, how can you increase the return? And of course, along the way, we'll also discuss a few tips about what might actually be much better ETFs. And as I've mentioned before, this is an ETF without America. And specifically for 2025, it could be quite interesting, or maybe 2026, because the market is hard to predict. Only American stocks are currently very high, and European stocks, and especially stocks from, for example, Asia and China from emerging markets, they are relatively a bit lower. So, in this case, the Vanguard All World ETF could be quite interesting. Generally, you don't want to invest against America. Never bet against America, says Warren Buffett. And that's something I believe in as well. America is definitely the leading nation in the world right now. And yes, Trump is in power. You can definitely find what you're looking for there. And I have no idea what the effect of Trump is. But overall, American stocks are indeed very high. And I myself have already been reducing many positions in my portfolio. But every month I give an update on my portfolio. So make sure to follow and subscribe to our channel. And then you'll get an update on the stocks that I buy and sell, and also the ETFs that I buy and sell. And the Vanguard All World XUS ETF is not included. This is just a relatively simple ETF for beginner investors, which can also be perfectly fine. That's also the emphasis. Low cost, simple passive investing. And we can also see why the fund contains more than 3,800 stocks. It focuses on Europe and the emerging markets. And yes, if this is the case, you already have risk diversification in your portfolio with about 15 to 20 stocks. And with 25 stocks from different industries, you actually achieve almost 99.7% risk diversification. So an ETF with 3,800 stocks is quite a lot. It simply means that you are investing in the entire global economy, except for the US. That's basically what it comes down to. Now, what is interesting is that if we take, for example, the S&P 500 or the NASDAQ 100, both index funds from America, then those price to earnings ratios are particularly high. Historically, they have indeed been on the really high side. And it could very well be that in 2025, there is a huge correction coming. The Vanguard All World US ETF, however, has a relatively lower price to earnings ratio of 15. Well, yes, historically speaking, 15 is somewhat neutral, average. But it could be the case that, especially since American stocks are often dominant, that Europe and Asia might have a slightly lower price to earnings ratio. But let's say it's, for example, 13. So 15 is still not on the very high side. The price to book ratio isn't very special at the moment. And the return on equity is also a bit lower than what you would see for the S&P 500. That's because there are also some not so good companies in there. But diversification here, what is the main focus? So you are actually investing in a fund that is not invested in America. And I honestly wonder about the very long term, and I'm talking about the next 20 to 30 years, whether that's such a good choice. We'll also see that in the performance returns, where we'll talk more about that later, especially in comparison to America. Then I think, yeah, why would you actually want to invest against one of the strongest countries in the world? unless you have a crystal ball about what will happen in 10 or 20 years, especially in relation to China, which has a lot of American. We say that it has debt sharing. So America has a lot of debt to China, and China might take advantage of that, but no one knows how that will develop. Emerging markets make up 25% of this ETF, and also Europe, 40%, quite a lot. Now, Europe, I come from there myself, but I'm not really impressed with the level of innovation in Europe. A lot of rules, a lot of bureaucracy. Yeah. It's all a bit better organized in America in terms of culture. Of course, all for the entrepreneurs. Lower taxes, tougher work culture, that kind of thing. Part of the investment in healthcare has gone into the Pacific, so you actually have quite a lot of diversification all over the world, except for America. That's what it comes down to. And if you look at the top 10 holdings, it really doesn't matter that much. Follow this ETF because it contains more than 3,800 stocks. So statistically speaking, you can't spread risks more than that. Let's say, yes, and that's it, top 10 holdings. Then you actually see, but TSM, Taiwan Semiconductor, has an allocation of about 2.7%. Well, if TSM were to go all the way down to zero, it would still only be 2.7%. So the impact of an individual company or stock is very minimal within the fund. So you have a lot of diversification, and you could also say it's proportional diversification. There are quite a few interesting companies in there. Of course, TSM is one of them. SAP is very interesting because of the switching costs. But for example, TSM, looking at SAP, for example, we see that Taiwan Semiconductor, its valuation has also gone up a bit after a price to earnings ratio of around 30, while normally it's 25 and even considered cheap, maybe around 15 for a company like TSM. For example, SAP is a similar story. That price to earnings ratio has really gone up, even above 50. So if you purely look at the growth prospects, and they are already very impressive, as we can see below, this is the EPS, which stands for earnings per share, and that's what it's all about in the world of investing. Companies have earnings per share, and the higher the earnings per share, the more the company is worth, which naturally increases the intrinsic value. And you can see that the valuation is already relatively high, and especially in relation to the future profit forecasts. Yes, then SAP would need to achieve very high profits to justify the current valuation. So a chance of loss from this peak is actually plausible. And this is a little bit, yes, that's the case for a lot of stocks at the moment. But for example, a Nestle, on the other hand, has already dropped a lot. And this stock, as an example, is, of course, a bit more attractive. Let me show you a quick example. We're here for the ETF, but you really need to understand what an ETF is. An ETF is nothing more than a weighted average of a lot of different stocks. In this case, the impact per share is minimal, as we discussed, but it's still informative to understand how you can now outperform and how you can achieve much higher returns than simply an ETF. An example is, for instance, we just saw SAP. It has a relatively high valuation. The same goes for Taiwan Semiconductor, but that one is still in terms of valuation. Okay, so SAP is a better example, and it has a very high valuation. Now take a look at Nestle. Nestle probably has less interesting growth potential, but the valuation has dropped after a significant price decline to a price to earnings ratio of around 16, and that is not to say that they are very cheap. But for example, Nestle, in the case that the current price keeps the earnings at 16 and the profit growth is actually minimal. As we see, minimal profit growth makes it easier to outperform. If that's the case, they can achieve a more attractive return than the company. What we just saw here before. If that price to earnings ratio rises to more positive levels, it could even mean an average return of 15%. So, 1. An ETF is nothing more than a weighted average of all these stocks that are in it. In this case, it's 3,800. Very good to know. You can outperform by simply selecting the best stocks yourself, and also to buy and sell based on valuation, but that last part isn't necessarily required. You can also just buy and hold great companies, but with an ETF, because there are so many stocks, 3,800, there are also a lot of them, rotten apples in between. I might as well say it's good to realize all of that. But if you say, hey, Rick, I just want to invest passively, yes, then this is a cheap fund that allows you to invest very passively. The return won't be super, and I'll show you that in just a moment. Why? First, let's talk about the dividend. The fund pays out relatively a lot, quite a bit of dividend, and I think it comes down to a dividend yield of about 3% per year, and it pays that out too. If you are with your broker, if you look up the ticker, you can always see if it pays out yes or no. If distribution is listed, that stands for distribution. That means that IT pays out dividends. It says ACC at the end. That means accumulation. That means that the ETF does not pay out the dividend, but automatically reinvests in its own fund for more productivity. Price, return. Good to know then. A number of other interesting characteristics are that, first of all, we use a data tool ourselves, and you can access it here through the about links in my description of the YouTube channel. You'll also get a discount on that. In addition, we also offer ETF insights on our website for investors. This way, you get monthly updates on the potential best ETFs, plus an analysis that we select ourselves of potential ETFs that could perform better. Those are actually always themes, ETFs, and the VEU, the Vanguard All World. We actually call an index fund a global ETF because it simply has global diversification. A thematic ETF can also be global, but is often focused on a specific theme, such as technology or biotech. But what's interesting to see is that one of the tools we use, we can see here on the screen, and that's a kind of rating. Compared to more than 3,000 other ETFs, and actually for a long time, the VEU hasn't been interesting at all in terms of rating. So it's often a sell or a hold, but it's rarely actually a buy. And that has a lot to do with the momentum, and we'll see that reflected in the overall performance of the fund. You shouldn't expect too much return. I can already give that away. So the question is whether this is actually a really good investment, yes or no, and personally, I don't think so. I think there are better ETFs, and we share those on our channel. Also, several videos about with dividends. Accused, with ETF analyses that we believe could be better investments, at least for this year, but also for the long term. So definitely check out our channel, visit our channel, and watch these videos for inspiration. There's a good chance that you'll achieve higher returns because of that. Well, there's a big advantage to this fund, the Vanguard All World ex-US Dividend ETF, that it's cheap with the expense ratio, and we have seen the website states 0.04%, and we see here in the tool 0.07%, and for me, at the broker, we just saw 0.01%, so the costs can vary slightly depending on the investment platform. But if you were to take the original ticker, it should be around 0.04% and not 0.07%. You can also see that the median of all ETFs has come to 0.5% costs. So that's a huge difference. And if you want to invest passively in ETFs with a lot of risk diversification, I don't want to say that it's safe, but there is a lot of risk diversification, then it's best to choose a very cheap, choosing a fund. Looking at a bit of dividend, we see that it pays out about 3% in dividends. In the next view, that's somewhat comparable to the median of other ETFs. But in terms of dividend growth, not at all. Very impressive. In terms of volatility, it's also sometimes expected with risk. The standard deviation is 10. That means that the price fluctuations are actually relatively limited. However, that's theoretical, and soon in practice, we will see that if you're a long-term investor, that volatility can sometimes feel much higher for you. Other things are positive here. For example, the top 10 holdings make up only about 10% of the entire fund. And we've just seen that here about the holdings, they only make up about 10% in total. In comparison, some high-risk thematic ETFs can potentially achieve a lot of returns in a shorter time. Sometimes have a percentage of top 10 holdings of about 60 to 70%. So then you have very concentrated ETFs. But in general, the rule in investing is that you can only beat the market average if you invest in a concentrated way. So for example, a Warren Buffett or a Charlie Munger, those are very good investors. Not all empathetic, but those good investors, they always invest in a concentrated portfolio, and that can sometimes be just 3 or 5 stocks. And others, for example, have 10 stocks. Some have 15 stocks, but never really more than 15 stocks in their portfolio. And this ETF, it contains 3,800 stocks. So that's a huge difference. So don't expect to achieve a high return, at least not higher than average. And it's also the case that American stocks are not included. And this shows that American stocks have generated most of the returns over the past 10 years. Well, one positive thing is the liquidity. Assets under management is very large. namely about 55 billion that it means for you as a small investor, let's say you have 10,000 or 100,000. If you want to sell all of that on a daily basis, there's a good chance that it will just work out because you see that the average daily volume is in the millions. So you can relatively quickly exit when you want. But I think the essence of a global ETF is that you mainly keep buying more. Speaking of that, ending with a piece. How can you increase the return? What's super important to know about a global ETF, in this case, the Vanguard All World ex-US ETF, is that there's no guarantee of returns. In fact, in the prospectus and information documents of the ETF, it states itself that in an even more pessimistic scenario, you can achieve about a 10% return over the next 5 years. But in a moderate scenario, that's only 6%. And in a worst case, that's even 0% or even minus 20% over the next 5 years. Very interesting. And why doesn't that mean this is automatically a really good investment? So I am very cautious about it myself. It is indeed a good buy fund, but you'll see that here in the year 2007. If you had jumped in at the peak, and unfortunately a lot of people do jump in at the peak because then it all becomes popular, you'll see that in 2025. So just barely 20 years later, you literally just lost. And not only do you have a minus 4% loss in value, and on top of that, you have 20 years of inflation that's going down. So that minus 4% might actually be, I don't know, minus 30% or maybe even minus 50%. That inflation has a heavy impact, and you don't see that reflected in your return on investment. What also stands out is that you should never jump in at peak moments. But yeah, when is the peak? Nobody knows that. So what is actually necessary as a beginner? Investing means that you continuously buy more, preferably monthly, or for example, every quarter. But you need to buy periodically. And a very simple technique to increase your returns is to buy a lot more when prices have dropped significantly. 2007 is, of course, an extreme example with the financial crisis. But you see that a global ETF is viewed as safe. Some people use the word safe. Do I sometimes catch myself saying that, yes, a global ETF is safe, but that's not the right word. It simply has lower risk than averages out, but that doesn't mean it's safe because you'll see that sometimes you just have periods where you're actually losing. If you had jumped in at the peak of 2007, you would have even seen a drop of 60% during the dip of the financial crisis, minus 60%. So 10,000 euros was only worth 4,000 euros. And then a bit of inflation is deducted from that. On the other hand, in that same rise, it was 100% return in about 2 years. So it's actually very simple and everyone can see it already. You just have to buy when the market drops a lot. And that drop is quite significant because we already see a decrease of about minus 26%. And it really looks so simple. Just think carefully. So this is a year's time difference. This small piece here on the graph. So you have to watch your wealth stay in the red numbers for a whole year. And what happens in practice? At Happy Investors, we guide countless people, and our community is growing super fast, almost over 1,000 in a very short time. And we just know from experience with a small number of people, the beginning is really tough. And a lot of people panic because they think I have a relatively low risk, bought an ETF, and I should still be making a return. Not much, but still a return. And then suddenly I'm at minus 26%, and that's a whole year. Yes. Welcome to the world of investing. No, it's precisely during all those big drops that you should buy more. Because if you had done that, you could indeed have realized some returns. But this 40% is also over a period of 2 years, so that's not exactly amazing. Actually, every time there's a drop of minus 10%, you really want to buy a lot more. You buy extra when there's a drop of minus 20% or even minus 30%. Like here during the Corona crisis, that's a nice bonus. But the golden rule is only invest money that you can afford to miss for the very long term. And in this case, the long term means about 3 to 5 years because you really want to take advantage of those upward movements. When you bought more during the dip, it was expensive. And here, emotions are super important. So another practical tip, don't download an investment app on your phone because you're going to check that every day and it's completely pointless. You should actually just buy every month. And if you see, hey, he's already done a lot with 20%, then you simply buy a lot more and you keep repeating that process. And actually, here's another bonus tip, but everyone will see this on their own. Of course, you want to sell when you have a lot of increases, but this is a tricky thing to sell because you never know when the peak has been reached. Now, the question is, of course, about the short term. Yeah, what is he going to do? And based on technical analysis, it seems a downward trend is starting to form for 2025. The price earnings ratio isn't super high, finting. So yeah, the question is, how far can it drop? It seems that it can't drop too far, but a price earnings ratio of 15 doesn't necessarily say everything, because when a crisis or recession comes, that price earnings ratio drops quickly. And could it actually drop a lot? Currently, in the short term, it has dropped by about 10%. Then it rose a bit. So with every 10% drop, you definitely want to buy more. But the more fundamental question is, do you really want to buy this ETF? For example, there's also an all-world ETF that includes America, and maybe that's a better choice. But the downside of that is if we take the eShares Core World ETF, I think that's a great global ETF, but the downside is that it has a lot of American stocks, namely 70% America whole and 30% the rest of the world. So yeah, that's the big difference with the Vanguard All World. Yeah, the difference is also very clear. In terms of returns, if you had jumped in at the peak here in 2015, well, then you had minus 20%. During the decline of the Corona crisis, you even had a very small gain. But if you had held on afterwards, you would have had a higher return. And here we see that again. If you buy more with all these smaller drops, then the short-term return can actually increase a bit. And if we compare that with, for example, the S&P 500, it obviously has a longer history. Then we actually see the same pattern. And also, if we take, for example, to take a NASDAQ 100, then we see a similar pattern. I need to check which tickers we take. Unfortunately, none of these are good examples. Let's take a look at the indies. This is a better example. You can see here for the very long term that the NASDAQ 100, but that's a completely different type of ETF. But you can clearly see a difference in terms of return here. We had seen at an ETF that this analysis is about, you had invested at the peak of 2007, and in 2005, you had minus 4%. So almost 20 years later, you were still at minus 4%. And then inflation had to be deducted from that. We just saw that in this analysis. Imagine instead, you would have bought the NASDAQ 100, which is, of course, much riskier, at least in terms of price movements that show more fluctuations. But if you had done that, then you wouldn't have had minus 4% during the exact same time period. Price loss plus minus inflation. But instead, you would have had a price return of 940%. So that's your money. Turn 10. Inflation still needs to be deducted, but this is obviously a huge difference. So the question is, the NASDAQ might be a bit too risky for a beginner investor, depending on what kind of person you are. But you also have the S&P 500. Of course, it only contains American stocks. But why would you invest against the strongest superpower of the world? At this moment, maybe the only reason and the answer to your question is because the VEU ETF has a relatively lower valuation. The price to earnings ratio is 15, while the S&P 500, for example, is at a price to earnings ratio of 27 and adjusted. Depending on the specific indices, it even stands at 35, depending on which perspective you look at. So it's quite a bit higher than the Vanguard if you want, but again, the return over the very long term, it might be disappointing. So if you decide to invest in this, which you definitely should, it's about first investing for the very long term, preferably 10 or 15 years. And secondly, only invest with what you can afford to lose. And thirdly, always buy more during significant price drops. Ideally, you buy more after a drop of at least 20% and just stay patient and wait. Well, one advantage is that it's a relatively cheap fund, low management fee. But you also see that there are potentially much better ETFs to invest in with a huge difference in returns. And we also call that, in the world of investing, opportunity costs. You can only invest your money once, so you need to determine, this euro that I'm investing now is the best possible investment in relation to its risk and return. Only you can determine that. But one thing is very important to know: the more research, the more you do, the more opportunities you see, and the better you can weigh those opportunities against each other. So don't limit your research just to this ETF, the Vanguard All World ex-US ETF. So I want to share with you and show you that there are possibly much better investments out there. And that can make the difference between a nice return or a super nice return in the long term that makes you financially free and even allows for early retirement. And that's why we're here. Happy investors. Simple investing with confidence to help you achieve financial freedom. If you appreciate this video, please give it a like and subscribe to our channel. I would really appreciate that. It also helps our channel grow. Until next time.